knows.
Hey guys, it's your girl Ree Henderson with Reyes Real Estate, here again with our second video. Today we are actually going to discuss some really important information here. Right now I am sitting with Mr. William Chase of New American Funding. He is going to cover this information. Go ahead and pull out your pencil and your pen and your paper so you can start taking notes. So today's topic is the 4 C's of obtaining credit. All right, so we talk about this often. There are several factors that go into qualifying for a home loan. It's not just your income, it's not just your credit score, it's a combination of things, and these things together tell us what your credit worthiness is. Can you tell us today what are the 4 C's of credit?
Well, the 4 C's are credit and character, capacity, collateral, and capital. So essentially, each of those sections that we'll kind of pick through a little bit in this have something to do with how you can get approved for a loan. So when you look at things like credit, the first thing that comes to mind is credit score. Mm-hmm. So what's the ideal credit score that's needed? People always want to look at Credit Karma. Yeah. We hear it all the time, but the ideal credit score, you want to be at least above a 580. Okay. Ideally above a 640, because that's when you're going to get a decent rate. But anything above 580, we can make happen. Okay.
But there's other factors that come into.
There's other factors.
Okay.
And when you look at Credit Karma, for example, with Credit Karma, there's different types of credit scores out there. People don't realize that. It's a Credit Karma is the Vantage score, and when you look at the Vantage score,
it's awful. It's a bad score.
It's for consumers. It's for consumer debt. It's used for credit cards. It's used for the general public to know what their score is. But you also have mortgage scores and you have automobile scores.
Isn't it true that the Vantage score is usually somewhere 60 to 100 points off?
Higher or lower, yeah.
Yeah.
It's a number. That's all it is.
It just depends on your type of accounts found in it. Okay. Exactly.
What that Vantage score is really good for, though, is to keep an eye on your trade lines. And if you don't know what a trade line is, that's your open lines of credit. Okay. Whatever it may be. Credit card, car payment, mortgage payment, something of that nature. If you look on Credit Karma, it will show you when the lates were, how late they were on your report, everything. Those kind of stay standard across the board. Okay. The algorithm of how they calculate those numbers is completely different. Yes. Now, along with that, you want to also look at, for the mortgage side of it, because this will affect your credit as well, are collections, tax liens, judgments, things like that. If you've been taken to court and they say you have to pay a creditor a certain amount of money, pay them. There's no way around it. It's Uncle Sam. You don't mess with Uncle Sam. Okay. Now, well,
what about those collections that are like say a car repo or credit cards that went to collections? How bad do those things really hurt?
For score, it depends on the age of it. If it just happened, it's going to severely hurt your
Within
score.
2 years, correct?
Yeah.
Okay.
If you're at year 6 of the 7 years it's going to take to get off, it's still going to affect you, but not as much. Don't reopen it, because as soon as you reopen it, it's a whole new problem again that starts the 7-year clock again. Okay. And is not forgotten, and it sits on your report longer and will keep your score lower. So if you have collections, judgments, and tax liens, it's those things that you have to pay them. You just have to, especially if it's something that is federal. If it's federal debt, you don't mess with Uncle Sam. Mm-hmm. You gotta pay him back. Now, collections that are over $2,000. Anything collaboratively, if you have collections, let's say you have a small collection, and I'm not talking medical. Medical doesn't matter.
Told you.
It really does matter. It does not matter. But any other collection you may have, you have cell phones, cable, electric, whatever it may be, if you have any of those and it's under $2,000, don't worry about it. Collaboratively. So if you're at $3,000, I have to count 5% of that total amount. So it's not that terrible.
But when it comes to getting the house that you want,
it's gonna lower your pre-qualification. Okay. But it's also gonna affect your score. Other issues that come up with credit quite often that I see, student loans.
Yes.
We all hate student loans.
Yes.
Every one of us do.
Yes.
I pay my piper just like everybody else's student loans every single month, and a little piece of me dies every single month. But they're in deferment, I don't have a payment, or I'm in an income-sensitive plan where they don't make me pay anything.
Number one remark. So it's usually what, 1% or what shows on the credit report?
Mm-hmm.
Okay.
If you have $100,000 in student loans, which some people do, believe it or not, that's $1,000 a month taking off your debt to income ratio as part of your debt. $1,000 a month, unless you're making $7,000 or $8,000 a month yourself, or together with your spouse.
And they have low debt too. And
they have low debt as well. It's going to hit you pretty hard.
Yes.
It's just the truth of the matter, unless you have a co-signer.
Okay.
There are solutions to it. It's just you need to know what your solution would be, because we have to count 1% of the total lien if you have no payment on it. Now, with credit repair, because this is the last thing I'm going to talk about with credit. Okay. Credit repair does exist, obviously. We all know about it. We all hear about it. 90% of them out there are snake oil salesmen.
Keep you on a monthly so they can collect their money.
They're going to put you on a monthly, and they're going to put what's called a dispute on each one of those problem areas. Disputes cannot, unless you're a veteran, cannot be on your credit report. So you have to undispute everything and watch your credit score drop sometimes. That's why it's good to get in with a really good credit repair person that understands the mortgage process and knows not to do that. The pay for delete usually is the best way to go, because they'll get it deleted from your credit report.
Now, I heard somewhere that was illegal, or some companies said it was illegal to do, but...
Crediting companies? Of course they're going to say that.
Yeah.
Think about it.
Yeah.
You know? It's not exactly illegal, because what some of these creditors are doing is illegal.
That's true.
They can't have collections in the state of Florida, yet they still try to collect from you. This is where a credit repair person that knows what they're doing and is worth their salt can take care of that for you and say, listen, I'm going to get a lawyer and sue you if you keep trying to collect from my client, and you'll see how quickly the cockroaches scatter.
That's true.
You know, okay. So it's things to just take into consideration.
Talking this credit, now, you know, I get this a lot, and this is why I ask. So, if you can mess up your credit overnight, just with a whole bunch of pulls. But I think there's a misconception that they can just pay the debts off and then their score is going to go up immediately. About how long does it take for the correction to occur?
30 to 60 days, depending on the debt.
For a late payment or collections?
For a late payment, 7 years.
For collections?
For collection, 7 years. So if you have something go to collections, even if you satisfied it, it's still going to sit as a mark on your report. So it's going to be there for 7 years unless it gets deleted through credit repair or something.
But it's not going to increase your score overnight by paying it off today.
Not usually. There are some, and this is again where you want to talk to your mortgage professional.
So don't waste money on stuff that you don't have to waste money on. Talk to us first.
Don't just throw money at a fire, because it's just going to burn. That's all it is. Next C, capacity. Your ability to repay is what capacity is. That's your income, your monthly income. It can be used, there's two different ratios we look at. It's what's called the front end ratio and the back end ratio. Now, this is mortgage talk, obviously, but the front end ratio is just the housing payment. That's it. And that cannot exceed, in most loans, about 45%. It cannot exceed it of your total income. Now, you have what's called the back end ratio. The back end ratio, depending on the loan product, can be as little as 43%. Or as the max number, and up to 56.9% in some of the ratios, with the exception of VA, and there's different rules with VA. But when you have those ratios, you have to stay within those numbers, and this is where some of the frustration comes in. But the reason why these exist is so you have the ability to repay that loan comfortably, where you're not going to be as house poor as you want to be. If you live a lavish lifestyle and don't want to afford that max number, thank you, that makes my life so much easier. But when it comes down to it, when you are at that max number, your realtor, good old Ray here, will be calling me every single time you look at a house. Hey, will this one work? Before we even go look at it, to make sure that we can actually put an offer that you're going to get approval on.
Yes.
You know,
very important.
Because she doesn't want to set you up for, I love this house, but I can't afford it. Or I need to put an extra $10,000 down so I can afford it. Because we're not looking at the loan amount, we're looking at what the monthly payment looks like, which includes the loan amount, but also your
property
mortgage insurance, taxes, HOA, CDD if it is one of those areas that has a CDD, which that's a whole other discussion for another day. Essentially an extra tax is what you're paying.
Right.
Along with any other insurance that might be needed, like flood insurance, things like that.
And the HOA, you calculate that as a part of it, but it's not actually paid monthly on it, correct?
Exactly. You do have to pay it separately, but it is part of your housing cost, so it still has to be calculated in.
Okay.
So when you have all of those together, that's what your housing payment's going to be. Now, what you're comfortable to pay with too, because my rule always is what you're most comfortable with as well as what your max is, because sometimes those numbers aren't the same.
Mm-hmm.
My general rule is for about every $100,000 borrowed, it's about $750 on your monthly payment. So if you're looking at a $200,000 house, you're looking around $1,400 to $1,500.
That's correct.
Which is right in that range.
Unless it's in one of those high HOA areas.
Or high tax
yes, exactly.
Like here in the Orlando area, we have
yes,
the tax rates double, almost triple at some points.
Yes.
The HOA is almost triple of what a pre-qualification would be.
Yes.
And I'll do an estimate usually based on what most of the Orlando area is on an HOA. Collateral. What is the collateral for the loan? If you're looking to buy a house, what's the collateral?
Yes.
What is
the collateral? Is that the house?
Is that the money? Exactly, it's the house. It's the property itself.
Okay.
So when you have the property, that's the collateral. What you're borrowing the money against is the house. So if you don't pay that loan, they take your house. Simple, right?
Okay.
How do we find out what that collateral is? We have what's called an appraisal.
Oh, that's that fee that you call and collect.
That people hate because it's $500 out of their pocket usually, or somewhere around there.
It's to protect you and you, correct?
It's protect the lender. It's also protect you. Why do you want to overpay for a house that's not worth as much as what it's worth?
Y'all heard that, right?
Everybody needs it. Nobody wants it for some reason. It's one of those things that you have to pay for. But what the appraisal is literally, it's there to protect you as well as the lender. It's the collateral. You know, this is how we judge the collateral. We don't judge it by the inspection. The inspection is just for you as a purchaser. I don't want to see that inspection.
So there's a difference between the inspection and the appraisal.
Yes. The inspection that you get in the first 7 days of your contract, don't send that to me. I don't want to see it. The appraisal is going to tell us any of the major things.
Roof, AC, heating.
Foundation, making sure the house is livable, essentially. The appraisal will say as is or subject to. As is this is what it's worth. You don't have to fix anything. So subject to could be subject to an inspection of the pool or a subject to the inspection of the roof because the appraiser saw something that might be a red flag.
Gotcha.
Those have to get fixed, which the seller might have to fix, you might have to fix. There might have to come to some kind of agreement to get it taken care of so it's doable. The max that they're going to lend to you is what the appraisal states versus your down payment. Now, if it appraises over, let's say you buy it for $200 and it goes up for $220.
Oh, we like that.
Instant equity. Yes, you do have equity on value, on what
but
the
it doesn't affect
value,
the loan, right?
but it's not going to affect the loan. You're not all of a sudden going to have, because you have 20% equity on an appraisal,
then you don't have
you all of a sudden don't have to put 20% down on the loan. You still do have to do it because you have skin in the game. Chances for your approval, if you have 20% down versus 3% down, your chance for approval at 20% are a lot higher when you have a bad credit score versus one that you have none, along with reserves.
Gotcha.
As well.
Now, what are reserves?
Reserves are money for a rainy day. Could be a retirement plan, investments. If you have a retirement plan with work and there's 10 grand in there that you just don't want to touch, I'm not going to make you touch it. Still want to see the statement so I can say, hey, listen, these people have 10 months worth of their mortgage payments sitting in an account that is a retirement. They're not going to pull it for down payment, but it's there in case they lose their job and they can still pay their mortgage for 5 months. That's a reserve.
Okay.
Now, capital.
That's number 4 or number 4, right?
That is the fourth one, yeah.
Yeah.
Capital. What is capital? Capital's money, right? not the capital of Florida, not Tallahassee. Capital is how much money you have for your purchase. There are products that we have that are 0% down.
Does that mean they don't have to have any money though?
Not exactly.
Okay.
When you have 0% down on the loan, that doesn't mean there's no closing costs. A down payment on the house can be between 0 and 20%, or as much as you want to put down. I've had people put 50% down. But
except for, you can't choose to put 0% down.
Yeah.
It has to be that type of
you
financing.
have to fall into that.
Yeah.
Ones that are 0% are a lot harder to get qualified for. If you make, in the state of Florida, I believe if you're a single person, you make more than $65,000 a year, you do not qualify for down payment assistance.
For the most part.
Yeah, for the most part. There are some programs out there.
Yeah.
That's why I paused for a second. Because there are
There's always the exception. Okay.
Closing costs for FHA are never 6.5%.
No, that's high.
Never, never, never. Even with a new build, never. With a new build of a home, it's usually around 5% to 5.5%, because you pay for every single tax that in the state of Florida. Some of them are paid by the seller. Builders don't play by those same rules.
Yeah.
Conventional is probably the easiest one to get a house collateral through with if the collateral has some issues. Conventional is a little bit easier because the appraisal is a little bit nicer. Or your equity. Let's say the market, like Orlando, raises 6% a year. So if you buy a $100,000 house, it's worth 106 now. Next year is worth 112. Next year is worth 118, and it's going to continue to go up. So in 10 years, your house is going to be might have $100,000 equity in it. You sell that house or refinance it and turn that into an investment to buy your next home. That's how wealth is built.
Yeah.
That's how people make money, right? So it's things to think about is, your first home's not always going to be your forever home. Some people it is. Some people go through that experience and they say, oh, the home buying process was so stressful, I never want to do it again.
It's not that bad. It's not that bad.
We do this every day, though.
Yeah. Just come to it with thick skin.
Come with it with an open mind.
And an open mind. You don't understand the reasoning all the time, but there's a method to the madness.
And that's why you hire people who know what they're talking about.
Yes.
So we can explain the messed up reasoning
right.
some of it is.
So they don't base. So what all do they base these programs off of?
The 4 C's: credit, character, capacity, collateral.
Okay. The financing products do not base it off of your familial status.
Nope. I do have to ask those questions, though.
Yes.
The reason why is there are federal laws with lending as well as being a realtor that we call the Home Mortgage Disclosures Act.
Okay.
Or HMDA for short. That's where I have to ask your sex, I have to ask your race, I have to ask if you're Hispanic or non-Hispanic. And it's usually how you associate as, because of legalities nowadays. I can't say, are you a male or female? No, it's what sex do you associate with most. Which with some people seems silly, but some people it's very serious.
Yes.
But those are protected classes. If I, as a mortgage lending professional, decide I'm only going to write loans to Hispanic Americans, or white folks, or black folks, doesn't matter what it is, I'm doing what's called redlining. Redlining is illegal. What redlining is it says how it used to be back in the 70s, way before you and I were born. Banks used to make a big circle in a certain area of town where they would not lend to. Usually with a red pen, hence the name redlining. Which would hold people down from being able to gain their wealth. Which still today people are feeling the repercussions of that since the 1970s. Still today. So we do everything we can to be fair. Personally, I love everybody. I don't really care.
Me too.
White, black, brown, purple.
As long as you're good people, I'm good people too.
Yeah, exactly. You give me a reason to not like you. That's the only time.
Right.
So I get along with everybody. That's just who I am, and that's what makes me who I am and makes me successful. So,
yes.
Because I don't care where you came from. I just care who you are.
Yes. That's important.
So if you are looking to buy a home and you're looking to obtain a mortgage, talk with Ree or myself. My number is 407-506-5650, and you can apply online with me too, www.williamchasemortgage.com, and it will take you to the pre-qualification link, and no pressure. You can start when you're ready to, and it will send it to me, and I'll give you a call. Whenever you're ready, we can get moving with it. It's not going to automatically put you into an application.
What states are you licensed in?
I'm licensed in the state of Florida, but our company is licensed in 47 states, and I can always send the business or send your information to one of my loan officers in another state.
So we got great information today. I hope these 4 C's help you throughout the process to understand why they're asking for all this information and why it's important. So once again, we have credit, character, capacity, collateral, and capital. You may not understand it all, but we're here to answer any questions and try to educate you so that we can make your home buying process a little sweeter, a little easier. That is it for today. So hit me up on the links below. His information is also below, and I will talk to you guys again soon.